Hello and welcome to Alpha Moguls Classics, a special show where we bring to you some of the best investment advice from India's top money managers who we spoke to throughout the year on Alpha Moguls. Let's get started. A lot of us ponder over our purchase prices and keep the losers in our portfolio in the hope that our purchase price will come someday. Samit Vartak of Sage One has some thoughts on that behavior and how earnings should be the only determining factor while choosing your stocks.
If you study each and every cycle, I think the companies who tend to deliver earnings during bad cycles, they tend to get re-rated the most. And I think this is the time to find such companies. I think the correction in the market, the indiscriminate correction in the small caps and mid cap has given you an opportunity to probably realign your portfolio. If you find companies which haven't delivered, I'm sure they have corrected. But in front of them, if there are companies who have delivered and also have corrected, it's better to swap them and probably realign your portfolio. You rarely get these kind of opportunities, and this is one such.
Very interesting. Kenneth Andrade was on this platform a few months back, and he said that maybe 2018 is what this volatility enables you to do is correct the mistakes, because where you would be in 2020 is not a factor of 2017, but what you do in 2018.
Exactly. And these are the decisions which will make a difference of X moving to 1.2X in 2020 or X moving to 3X in 2020. I think those are the kind of opportunities you will get. You got to look at the opportunity cost today. You can't benchmark your stocks based on what price you bought at. Just forget about the price you bought at. Just look at forward. Which are the stocks which will deliver going forward? Forget about how much you have lost in your existing stocks.
Let's now get views of Monish Pabrai on why do investors buy stocks, why do they sell them, and also what is the right time to do the same.
We've got two types of things we got to do with companies, right? So we're the points at which we buy them and why we buy them, and the points at which we sell them and why we sell them.
Sure.
Buying is complicated. Selling is 10 times more complicated. Okay, so when we're trying to buy, relative to selling, it's relatively straightforward. We want to know what the growth engines are if we're going after a growth company. We want to know what we're paying for that growth. And we want to try to figure out where is this company in 5 years or 10 years versus what we're paying for it. And so those are relatively straightforward compared to the selling question. The selling question is a more complicated question because one of the things we're forced to do is we're forced to look out into the future, maybe a few years out, to try to figure out what is the future of this business. And for most companies, even the insiders have a very fuzzy idea about the future. And so the thing is that if we buy a compounder at a value price, that's a relatively easy exercise because we're not paying up. But the difficulty comes in when it goes up in price and it looks fully priced, but still has a lot of tailwinds and still has great management, still has a lot of great growth in front of it. So the best that I've been able to answer the question is a great company with great growth, with great management, give them some leeway. So don't sell them when they're fully priced. Don't sell them when they're overpriced. Sell them when they're egregiously priced.
Okay.
Now, what each of these levels are, I'll leave to the viewer, but it should be obvious. When is it fully priced, when is it overpriced, when is it egregious? So what I've learned, one of my biggest mistakes has been is selling too early. I have watched 100 baggers that I bought who went on to become 100 baggers so many times after I was out. And I'd only captured the double or the triple, and I didn't capture the remaining 98 or 97 times that it went up.
But when you buy, you don't know it's going to be a 100 bagger.
Absolutely. In fact, you learn about a business only after you own it. So you may do all the analysis in the world, but you're really going to learn the business after you own it.
Well, keep it simple is what Mohanish seems to be saying. It is all about identifying the company which has the ability to dominate the profitability pool. That's the word coming in from Kenneth Andrade of Old Bridge Capital. Hear out his thoughts.
there are the investment styles. So the address the thing, can I buy a growth company which is growing at 15-20% per 15-20% a high number, but even 10 to 15% year on year, but trades at a 30 times multiple? That's an investing style by itself. Okay, there are managers out there, and a lot of my peer group does that very successfully. That's not the way I identify investing with. Okay, and that's not something that I would like to categorize myself in. For us, it's very simple. We need the valuation comfort, and we need the bottom of the cycle, or we need that business as it evolves itself. So to get in early into the entire cycle, we need to be there. Okay, just to highlight the fact that all these consumer names and all the names that we've actually taken together, you look at it in the last 5 years. The last 5 years have given you all the returns. Okay, the last 15 probably they're just about being with the rest of the pack. Okay, so it's just the last 5 years. So if you look at it on a 10-year perspective or even slightly longer, they're quite average companies over a period of time. So it's just the ability of a company to get dominance in a sector, and all the names that you pointed out, they account for 80% of the profitability of that business or that vertical or that cycle. It's about identifying whether they will be able to get there. Okay. So you look at the largest car company in India. His ability to command this multiple is not based on his ability to grow, but his ability to dominate the profitability pool of the industry that he is in. Okay, because if that industry profitability pool collapses, it won't collapse. It'll collapse around him. The smaller guys will actually vacate the space. Okay, which keeps him alive to dominate the cycle in the next cycle again. Okay, so I think when we look at it, and when we look at average price earning multiple numbers, you don't look at it on a 5-year context. You probably look at it on a longer term context, and you probably arrive at a number which is not so exciting. Okay. And in my experiences as a portfolio manager, we probably got a little bit of consumers right in 2006, 7, 8, and into this decade. But when he initiated that trade, all of these guys were at 12 times to 15 times to, 12 times to 15 times earnings. Even India's the largest auto company was at 12 times earnings. Your time was then. That's where I understood that business, or that valuation cycle, not really the business.
Well, maybe that's why they say bet on the leaders. Now, the next voice. Is monitoring stocks the only thing a portfolio manager needs to do? Ravi Dharamshi doesn't think so. Hear out what he has to say on this subject.
We are so focused on the companies that we are invested in that sometimes we miss the slightly bigger picture, and that hits us hard every few years. And 2018 was definitely one such scenario where macros came in, and out of the blue we had a sharp correction. For what happened in September, October, I don't think even the the most bearish of the guy would have anticipated this kind of a drawdown in a couple of months. And in the couple of months, only the large caps have corrected. Actually, the mid caps had been correcting since the beginning of the year. So on the top of a 30% kind of fall, another 30% kind of fall, 30-40% kind of fall in mid caps, and that really hurt a lot of investors.
Vijay Kedia of Kedia Securities, who speaks about why there is no need for an individual investor to look beyond a set of clean managements because he or she is not a fund manager.
I'm not a fund manager, okay, and I'm not managing others' money, and I'm managing my money only, and that's, of course, that is limited. So once I am invested in my whatever stocks I have selected, after that I have to do nothing. If I'm a fund manager and there is a constant flow of fund in my money in my fund, then I have to look for the stories every now and then. So to me, actually, there is nothing to do. Just to learn and just to read and just to get information, just to keep a track on my investments. So for me, 5 or 6 or 7 or 10 stories are enough.
That's the size of your portfolio? 10 companies, 12 companies?
Core portfolio is not below 10 shares. My core portfolio, majority of my portfolio, if you that would be not more than 10 shares. So for me to get a cleaner management and a management with a good track record, so I have to find only 10 shares. So I'm happy with that. If I have to invest in 100 shares and I have to churn my portfolio every now and then just to, because I do not have any pressure also that I have to maintain my NAV, that I am not accountable, responsible to anybody. So I think that is the difference between people like me and the fund managers.
Well, another advice from Monish Pabrai makes it to this list. He believes that buying a stock should be an exception and not the norm. Strange coming in from a money manager, isn't it? Let's listen in to what he has to say.
The first thing, if you're going to go buy some rice in the market, you're going to know what is the price per kilogram. So the first thing is that if you're going to buy a stock, at least know what you can buy the whole company for. And most investors don't have that knowledge, which is amazing. And so the first thing an investor ought to ask themselves before they buy a stock, even before we get to price and so on, is this within my circle of competence? Now, circle of competence is a very important concept, one of the most important concepts in investing. A person like Warren Buffett would consider something like 95% of stocks outside his circle of competence. And he says that, probably 97, 98% of things that show up on his desk go into a box called the too hard pile. He can't figure them out. Okay, so there's just a sliver of businesses. Now, if Warren Buffett can't figure out 95% of businesses, for the rest of us humans, we can't figure out 99% of them. So most things are going to be outside the circle of competence of most investors. So now let's say an investor answers the question correctly. Yes, I understand Apple, and I understand it's within my circle of competence, right? So the next question then comes up is the question I asked, what could you buy the whole company for? And then the second question an investor should ask is, so let's say an investor knows Apple is worth $1 trillion, for example. So the question I would ask them is that if your family had a fortune of $4 trillion, would you be willing to put 1/4 of that fortune into Apple? And if the answer is yes, buy the stock. If the answer is no, don't buy a single share. And so these are just very simple, which is, look at your net worth, look at your family's fortune, and are you willing to put 1/4 of it buying the whole company that you want to buy 100 shares of? And so these are basic things that most investors unfortunately don't focus on.
Yeah.
And so I feel that investing in stocks, figuring out what they're worth, what your circle of competence is, these are complicated issues. So for most investors, it's a really good idea to index. Because indexing, you can buy a Nifty 50 index or any broad index in India for basis points. The frictional cost for ETFs and all is very low. And the second is you average out over time. So every month when you get your salary check, take a small portion, first put it into savings, and then don't worry about it. What I would say is set it and forget it.
Fill it, shut it, forget it. The old Hero Honda ad.
Yeah, exactly. And so that's why I think that buying stocks should really be an exception rather than the norm.
Well, at times it's also about identifying the set of companies that you should buy. For somebody who tracks the consumer space very closely, Nikhil Vora had some very interesting insights to share on what are the standout features of a consumer company that will make you choose or reject from this space.
The fact is that as long as businesses grow, there is more than adequate pools of liquidity which chases that business growth. And as we understand consumers' businesses, they fundamentally require capital twice. One at seed stage and second at growth stage. If any consumer business requires capital third time round, it's not a consumer business. That I can guarantee with all certainty. So I think it almost always is a domain where if the businesses start to scale up and do well, there will always be huge amount of buyers who will evolve. And we've really found that across our own personal journeys also in the last decade or so, when I've been personally investing a fair bit of my personal capital into private space.
You purchase a stock and it underperforms for 6 months. You may be disappointed by this, but Vijay Kedia feels that it is not necessarily a bad thing. Hear out what he has to say in this regard.
you ask me, forget about 1 month. I usually buy a stock which I know that is not going to perform maybe for next 6 months. Because that is the time actually I am taking to accumulate stock from the market. And maybe the company has a turnaround, but it will take at least 6 months or maybe 9 months or sometime maybe 1 year to reflect into the numbers. So, but people want result in 1 month or 2 months or 6 months. So that is not the right approach to invest for long term. And only one mantra in stock market is to make money in market is to sit for long term only. You cannot make money unless you have patience to hold for your stock for 10 years or 15 years or 20 years. You certainly cannot make money in stock market. This is what I have experienced.
Well, along with Monish and Vijay Kedia, another piece of advice from Kenneth Andrade makes it to this list again. He speaks about how volatility helps one adjust their portfolio to where it will be in a few years.
Please remember this, you can't shift portfolios from where you are to where you want to be and where you want to be again in a matter of 6 months or 1 year. It's an investment process, and what you're effectively buying is you're buying companies and you're buying businesses that will map out in a 2, 3, 4 year structure. When you map out a business in a 2, 3 or 4 year structure, look, profitability doesn't double in 1 year. It takes at least 4 years, maybe 5 years for it to double itself. In an environment like in India, across the world, it takes much longer to do that. And that's the cycle. That's the way the corporate cycle actually evolves. So if you maintain that entire discipline, if you maintain that entire stance in your entire portfolio, I think you're pretty much safe. What this volatility enables you to do, so if I just eliminate the polarization that's taking place for this point in time, and what this volatility actually enables you to do is to correct the mistakes that you've made, even as a professional manager, as you get sucked into a market which has got enormous amount of momentum. Okay, and that's essentially what needs to be happen. So going forward in the next 2 years, okay, I think a lot of us will be asking ourselves, okay, were we in the right place in 2018? Okay, so going into 2020, your portfolio characteristics will have to be determined of not what you put together in 2017, but how much of that did you correct in 2018 if it needed correction. Okay. And that's what's going to determine your next 2 or 3 years. So it's where you are right now is going to determine where you will be in 2020, and that's the transition that most portfolio managers, including myself, have to go through.
And lastly, how important is the discipline while you make your investments? Hear out Ravi Dharamshi's views on the same.
Behaviorally, one needs to mentally adjust to being okay with subpar returns for a period of time.
Okay.
See, you cannot time the market precisely. Okay, I'm going to sell here and I'm going to buy here. So if at this juncture, I mean, again, going back to what Mastering the Market Cycles by Howard Marks, essentially you have to be in neutral mode at this point of time. The book talks about basically you have to understand where you are in the cycle. And by cycle, I mean, it could be a market cycle or an economic cycle or a leverage cycle. So if you are aware where you are in the cycle, and then you have to adjust your behavior to that portion of the cycle. And today where we are, I think we should be in a neutral zone rather than being very aggressive or very conservative. There were some concerns about overvaluation, and I think the 2 months of market correction took care of that. So again, we are probably at the neutral range. So now that is the behavior on how to, should I be allocating more to the equities? Surely, if your percentage allocation is not too high, then you should be thinking of allocating. But at the same time, it is not a rising tide. It is not like every company or every stock is going to do well. It will be a very nuanced market. It will be a very stock pickers market. It will be a very volatile market. And you will need all the patience, conviction, and courage that you can gather to hold on to what you have. So the point number 1 for creating wealth is to stay invested in equities through this volatility. If maybe, of course, some amount of pruning, some amount of getting out of stocks that you believe are deadwood in your portfolio and getting into something where the new themes are emerging, that should be broadly the strategy, in my opinion.
That, ladies and gentlemen, was a series of some of the top advice that we received all through 2018 on Alpha Moguls. But frankly, there's no substitute for watching the show in entirety. So I urge you to log on to BloombergQuint.com and watch each of the Alpha Mogul shows. Frankly, each of them is timeless.